Hello and welcome everyone to this very important video. Today we are going to jump into the latest update of the Tesla valuation model. You know that I'm using that model to predict what the share price should be, the fair future value of the share price. And it helps us in these critical times where we see a robotaxi launch just around the corner. You probably have heard it. June 12th is the circulated date right now on X. I think Bloomberg or something like that said that. Let's see if that is true, but we all know robotaxi is coming. We are currently at roughly 360. The stock is up very nicely today. We can take a look in a second. And it's all about the question, what do we think? What is going to happen and how we actually trade this whole thing or invest, whatever word you want to use for that. And let's take a look quickly at the stock price. We see a very nice little surge. I will share my screen so you have everything right here. So here is what the stock is doing right now. We are at 361, nicely up on this Friday. What is going on with the valuation model? I want to reveal my share price for 2028 so we can have an informed discussion about the upside. Before I go into the exact share price, let's jump right into the underlying assumptions of that model. And here is where the rubber hits the road, like figuratively and metaphorically. Here's my demand inputs. That is what we have to really watch out for. Here is what I'm projecting for these years ahead of the two central things we are looking at: Optimus and robotaxi. And as you probably know, people like Gary Black, for example, completely ignore the two biggest revenue streams. We will look in a second what that actually means and what they're missing out on. But here's what I see on the robotaxi side. In 2025, you see 10. These are basically 100,000 robotaxis on the road. That is my projection. So these are in millions. Here's the robo fleet this year. Fleet means not what is produced per year, but how many are actually in the world, roaming around and doing their robotaxi business. So 0.1 million, so 1,000 projected robotaxis next year. That is my projection. This year doesn't really matter. So we are basically looking at 1,000 this year. Could be 2,000, who cares? But it's all about next year, 100,000. And then a big leap in 2027, because we're assuming here, we see the breakthrough next year, fully autonomy. This thing works, people use it, there's hype and all these things. It's in multiple cities. We see Uber getting killed. That is the projection for 2026. And that would then lead to removing the barriers of rolling this out en masse. There's still some regulatory hurdles to overcome in 2027. So we jump to 750,000 robotaxis worldwide. And then we go into hyperscale, 2 million, 4 million, 8 million, and so on. Now, let me just comment on these numbers here. So some people agree with that, others don't. We have to understand what it means to have full autonomy. We have to understand what it means if we achieve that in June, getting on this trajectory, getting the dollar per mile cost of transportation below $1 without any capital expenses on your side. You don't have to own a car. You don't have to seek public transport anymore. You don't need Uber. You don't need taxis. And most importantly, you don't need any trucks or truck drivers. All of that is a little bit factored in here. So the robot fleet includes also any kind of trucks, by the way. And what you see when you think this through, I want to really open your minds to what this actually means. In the Singularity years here, 2030 plus, when the world will go through some extremely serious turmoil, the end point in 2040 is, I believe, we will have 220 million robotaxis on the road globally. Now you have to compare that to 1.5 billion cars right now. So that's still a tiny number. I think it's not realistic. I think we can have way more than that. I also believe that Tesla will have some very strategic advantage all the way through. And that is basically what we are talking about here. That is why this is such an enormous opportunity. I think we can hit 220 million install base. On the top level, you see the annual production rate. So this will stay below 10 million for a long time. So we will hit 10 million new cars produced per year in 2033. Most of them are, of course, robotaxis or equivalents. And that sets us up for a lot of success. Now, the other big trajectory is, of course, Optimus. And you see that I'm pretty conservative in these starting years here. The install base of Optimus, I assume, is pretty low. It's 50,000 next year, 10,000 this year. Right? And then we are basically going up very cautiously to 100,000 Optimus robots in 2027. So that's pretty much in line with what Elon also says. And here's the production rate. That's even lower, of course. And you're hitting 400,000 Optimus, produced in 2028. But from there, you see that takeoff. You see that the world got used to robots by then. We have artificial superintelligence very likely by then. And a lot of tasks will now be unlocked by these robots. And then we go into hyperscale. I'm still conservative here. You need to scale this stuff. There's always a lot to do. But we are hitting a run rate of nearly $1 billion in 2040, 2.6 billion install base. Now, this install base is very important for robots because we are talking about a RaaS model, a robot as a service model. So Tesla will generate money with every month this robot is in use. I estimate we are in the long term getting to $1,000 a month. In the beginning, it will be much, much more. But over time, we need to get to a very aggressively low labor cost for these robots. So you're talking about $12,000 the margin, nearly pure margin per year for the robots. And you can imagine this ends up being insane amounts of cash coming in. Now, the underlying reasons I don't want to go too deep into, I think all of you guys are familiar why I'm so bullish that Tesla will own both markets, will be the number one player in the world in both markets, especially in robotaxi. There is no competition in the world right now. I went into an X with you guys a little bit into a discussion that I believe FSD will get commoditized coming out of left field in 2028. But from frontier models, not from a car maker. So in 2028, I think there will be self-driving will be a thing that any phone will be able to do more or less. Any robot will be able to do, but no one will have the infrastructure of delivering robotaxi services because the car companies, most of them will be dead by then, and they will be utterly unprepared of doing that because they will be left out of the loop. On the robot side, I think this is a long story. We will have a dedicated series coming in June on the robots, what's going on there and why this is not just hardware. It's about intelligence. It's about new app stores. It's about sucking up the world's IP, industrial, physical IP and procedural IP of work into these robots. Long story, but Tesla will have an absolute advantage. It also has advantages in just terms of pure R&D spent on these robots. So it's very well positioned to own both of these markets. And we are talking about trillions and trillions and trillions of dollars in margin. It's all about modeling out the numbers. In an expected case scenario, here you have the numbers. I'm also assuming that the core business, by the way, grows at roughly 15% a year in perpetuity because of energy mostly. So that's nice. Now, what does it all mean for the share price? This is being translated here just to explain this quickly. I'm translating all these numbers, first of all, into actual models that explain the revenue in billion, the margin percentage, assuming certain OPEX criteria. So we are getting this into a cash flow situation here. You basically see the EBITDA and EBITDA margins for Tesla total, and you see how this goes up to 13 billion, 2025, 17. Let's see if we hit that. Doesn't matter too much. Next year, you will see a robotaxi delivering more and more margin into that. And then 2027, you see this takeoff of robotaxi. Hey, if you want to stay ahead of capital markets and the next Tesla moves, join us in Pioneerlands. Here we track Tesla, capital opportunities, AGI disruption, and politics. It's your critical information advantage in the age of AGI. It's free and the link is in the description. Let's get back to the video. So before we go into share price, let me show you a chart here to give you a feel why this is so crucial and decisive and why most analysts have it completely wrong what's going to happen. So what you see here you just see the EBITDA of Tesla over these next few years and what you see. Optimus, robotaxi, and core. Here's the EBITDA. This is the money Tesla makes per year. 2024, you're talking about $12.44 billion in EBITDA. You see the blue thing growing at 15%. And you see how little that matters. And what you see then is how much robotaxi changes the equation. That's the red. Optimus is the yellow. Optimus lags a little bit. But you can see by 2028, the core business already plays only a marginal role. And in 2029 is basically a rounding error, and then it goes through the roof. And the interesting thing is that's not far in the distant future. As you see in 2027 already that 50% or 33% of the EBITDA comes from robotaxi as quickly as 2027. And in 2026, that's where we can measure all these things in a very significant way. And when you understand how you value a company, I don't believe in price earnings ratios and all these stupid things. I think that is just beginner and amateur hour business. You can't do price earnings ratios. The only way to value a company and conclude the share price from that is through DCF, discounted cash flow. Because the truth is, a company is worth as much as it delivers in cash over the next 10 years. You can say 15 years. It's actually not that much difference because you have discounted, interest rate, cash flow. The longer in the future you look, the exponentially less money per dollar you actually get. So you can make your choice if you value companies of what they get you through the door in the next 10 years or through the door in the next 15 years. Doesn't matter too much for present value. And that is my approach to valuing any company, right? Because of that, it's very important to understand what revenue streams and margin streams, especially cash flow streams, that thing will have in the next 10 years. And that is my approach of valuing the company. Here, very important, I actually show you by year what the percent of share price is on a DCF-based basis. And you see already in 2024, my target share price, assuming that's whatever target share price we have, of course, the target share price goes up a lot. But here you see the percentage contribution of the future cash flows to that target price. So if you say the target was $400 for 2024, for example, we can look in a second what it actually was. I'm saying that 25% of that $400, $100 was Optimus, right? To make it simple. And the majority was Robotaxi. And only a tiny little fraction was the core business, because that happens if you actually project out the 10-year revenue coming in. Okay, now that is enough suspense. Now you see what's happening. You see that because it's a forward-looking thing into 10 years, you see that Optimus increases in importance for the share price target because it's forward-looking. Whereas you see on the EBITDA side, on the actual cash flow generated per year, you're seeing that Robotaxi dominates all the way to 2030 a lot. But because it's forward-looking on the share price level, Optimus dominates by 2030. In both instances, what doesn't really matter is Tesla's core business. And what matters even less is the car business, because energy is pulling off most of it in the future. So now you know some basics. So let's go to the all-decisive question. What is the actual price target? And here you have it. Based on all these considerations, further discounted with a risk. That's not to be confused. Discounted cash flow is not risk discount. It's interest rate discount, right? Because the money you get in the future is worth less today, because you would get interest if you would own it today. So 4,599. That is my fair future value share price for 2028. If these trajectories come to play, we're talking about $4,599 right now, given this, the current risk profile of Tesla and the trajectories we are seeing. So of course, that assumes that certain things go a certain way, but that's why we're tracking this daily. You also see for 2024, my fair future value share price here was 639. So, we were at 480 in December, so underperforming because people don't see these cash flows coming to the extent they very likely will. And you probably also are interested in what I'm thinking this year. 1,060, I think, is the fair future value this year, 24 and 2026. Then 2,800, then 4,500. So you see a very nice CAGR, compound annual growth rate here for the shares, because you see this massive increase in revenues. And that's reflected here. We are going from 95 billion to 110 billion to 135 billion. Then we get into the bigger leaps because of Robotaxi, nearly 200 billion in revenue. Much more important, by the way, than revenue is how the EBITDA grows. The EBITDA grows dramatically. Look at that. This is crazy growth, right? Here you see a big leap because of the Robotaxi leap. So 25%, then 18%, but then 78 in 2027, then it hits, then 252%. And then it continues growing at a very high rate because robots and Robotaxis are so much more high margin businesses. So here you see a quick insight how I think around these things. I will always adjust these numbers, by the way. They change weekly. I'm updating them. It's only tiny little tweaks based on what we see, trajectories, because all these numbers change if you change these numbers here. These numbers are the key, all these blue inputs. That's where you can actually decide, okay, do we believe we have 100,000 Robotaxis next year? Do we believe we have 5,000 Optimus robots? 50,000 Optimus robots next year? Or do we change something to the upside or downside? And that has a direct impact on these numbers. So there you have it. That is the target share price. By the way, you have to always consider this is not what I'm saying the share price will be. That is what I'm saying the intrinsic DCF value of the company is if you translate it into the share price. The question what I believe where the share price actually goes is a complex equation that depends on sentiment, depends on your money on the sidelines versus money invested. It depends on a lot of things. Maybe you ask, Joe, what's the point of these numbers if it's not your actual share price target? Well, that is the fair future value. That is the forcing function where the share price has to end up. So if the share price lags behind in 2024, it was at 480, but it should have been 639 if people would understand the future. It means it lags. And that means this year we see an even higher pull. Now it has to go to 1,000. If it keeps lagging and only goes to 600 this year, for example, well, we know it has to do some serious catch up. If it then goes to 1,000 in 2026, we know serious catch up. Why is it so important for me? Because I know as long as the actual share price lags this share price or this target future value price, we have a problem and Tesla is highly investable. If we go into some crazy exuberance, which can absolutely happen, it could even happen this year that Tesla goes to 1,500. I tell you guys, could happen. But if that happens, I'm saying, well, now if we go to 1,500, for example, this year, it's pretty obvious to me that it's incredibly unlikely we don't drop off a lot in between because that's the end of year price, right? If you would be in September this year at 1,500, I would say there's no way in hell that we are not seeing lower numbers before end of 2026. That's how you have to think about these, right? If you exceed these by a lot, the probability that you don't have a major drop in between to the end of the year after is incredibly low. So that means probably pull back a little bit in your portfolio. But we are far off that, and we have a long way to go before even hitting these numbers. That's why I'm so bullish on Tesla right now. Last comment, since we are in the model right now, and I know you guys like it, here is the price earnings ratios. And what you see, just to explain how these price earnings ratios work and why they are so dumb, that's what most analysts look at. Oh, it's expensive. It's 280. That's way too much. It should be 35. Well, guess what? Price earnings ratios are completely meaningless if you have these volatile or highly changing or highly exponentially improving cash flow situations, earnings situations. What good is it that you say it's too expensive at 200 price earnings if you know the earnings tenfold in the next 3 years? Nothing, because of that tenfold, the price earnings is not 200, it's 20 forward looking. I mean, the price earnings only make sense if you have stable earnings over many, many years or very low growth or low decline earnings. Then you can look at price earnings ratios. But if you have high growth or disruptive growth, if you have any company that is adding any major new revenue stream in the very close future, price earnings make no sense. It's like a startup. It has an infinitely high price earnings ratio because it has no earnings. So you're dividing by 0, your price earnings is infinite. You say infinite is too expensive to me. You know, like the price might be 100 million, your earnings are 0. So your price earnings is infinite. Infinite is too expensive. I can't buy you. Well, guess what? If you have a contract coming in next year that makes you 100 million in earnings, your price earnings effectively forward looking is not infinite, it's 1. So you must be a little dumb to apply price earnings in a situation like Tesla, where you have two major, completely new, not presently represented in earnings, revenue streams or margin streams coming in. And as you see here, the effects are very clear. Here's a 1 year forward price earnings ratio, and you see this is already much lower. So you have 257, for example. Your price earnings ratio of Tesla at that price in 2027 would be 257, which blows the minds of every Wall Street analyst, and they would say, you are nuts. But just looking 1 year ahead, the 1 year forward PE on that price is only 73. So on that price, same year, 257. But if you go 1 year forward, it drops to 73. And you can see that continues to happen. Here it's 119, already dropped a lot in 2028. And then price earnings drops to 60 forward price earnings. And here to 50, and here to 47. So you have a forward price earnings of 47, while you have an EBITDA growth rate of 33% a year. So there you have it. So my model is actually extremely conservative. All these prices are super low once you accept or believe in these trajectories. This is a very conservative financial model. The only thing that you could say is not conservative is my revenue and margin projections, specifically the demand projections. And that is exactly why we are here in this channel, why you are following the cyber bulls. I'm the pioneer bull. I just went on with Herbert again, and Alexandra and CERN was amazing, coming out on Sunday. But it's very important to understand these future revenue streams and margin streams, because if you don't, you will get it all wrong. You can't look in the rearview mirror and saying, oh, the price earnings is too high. What you have to do is understand the future, do these projections right, go to pioneerlands.net, go to the Pioneer Academy. We just had to increase the price to $19 a month, but it's not a lot. One trade that is informed better, and you're making infinitely more than that. But you can get all these models there and give your own input, and you can customize these models and put in your numbers and your assumptions and see what actually happens, what the sensitivity of the stock price is to these numbers. What happens if you're only at 1 million robo-taxis on the road in 2028, and what happens if you're at 4 million? Dramatic things happen. So that is very important, because we're tracking what's happening and reverse engineering the share price, the fair value share price with it. And that's how we won so far, and that's how we are going to win going forward. So I hope that was helpful. I hope you enjoyed these little charts and the model. I remain extremely bullish. June is coming. June 12th is coming. We know that Tesla is already testing their robo-taxis as we speak in Austin. I just tweeted it yesterday. And the future looks bright. See you very soon.